You're entering the future-ready CNBC TV18 EBIX Cash Studio.
Good afternoon, you're watching us here on the CNBC TV18 EBIX Cash Studio. I'm Manglam Malu and we will answer all your mutual fund related queries. This is the MF Corner. It's going good for the market. Most of the gains today on the Nifty are contributed by Reliance, which is standing head and shoulders above the other stocks. But it is the Nifty Bank which is putting a lid on the gains that we're seeing. So the last couple of hours will be extremely interesting for trade, given it's also the November series expiry. But let's talk mutual funds now. We are joined by Harshvardhan Roongta of Roongta Securities and Gaurav Gupta of G-Cube Securities as well. Let's go to the first question. Arjun Radhakrishnan has shared his query on Twitter. He wants to know about RBI's retail scheme and an opinion on if it is a good debt instrument to consider. Harshvardhan, your thoughts?
Yeah, hi Manglam. Well, this is one such scheme that RBI has introduced so that the investments into government securities can be brought to the retail investor. So a retail investor needs to open a RDG account, a retail direct gilt account with on the RBI. And, there he or she will be able to invest into the government securities. It could be the central government securities, the state government securities, investments into treasury bills, and even sovereign gold bonds. So earlier, the situation was such that if you wanted to participate directly into gilt market, the ticket size or the minimum lot size was approximately 5 crores. Now, with this account, a retail investor can invest as little as 10,000 rupees and can go up to 2 crores of rupees. So clearly, this is an attempt by RBI to broaden the market and to enable investors to put money directly into government securities if they wish. Now, particularly, I believe that this product suits very well for those who have just recently retired. I mean, so we're looking at retirees who've got a corpus in their hand and they're looking at a continuous or a fixed source of income for the rest of their life. So herein, they could invest into long-dated government securities, wherein they will be assured of a fixed yield that they enter into today. And that is the yield that they will get for whatever next 20, 30 years, depending on the bond that they buy. However, there was always an option to invest into gilt through mutual funds. So mutual funds had this basket of gilt funds, wherein if an investor would park money there, they would get a basket of all gilt securities. There would not be a specific particular paper that they were investing into. So, getting to know and estimate of what is the yield you get over long term was not possible. However, with this, of course, if there are any people who would like to trade in government securities and bet upon the interest rate movement, that again becomes possible by opening a retail direct gilt account and trading through that.
All right, that makes sense. The next one comes in from Pune. Sangram Shirke has written to us. He asks, against the backdrop of Evergrande defaulting on its debt and other Chinese real estate companies having high debt, he wants to know the effect of these developments on funds investing in the Chinese market. Gaurav, how many funds are there and do you think there would be a big impact?
Hi Manglam. As far as I'm aware, there are two funds currently, which is Edelweiss and Axis. Axis has recently launched about maybe 6 or 8 months back. So I'm only tracking the Edelweiss fund. What happened with this Evergrande crisis that happened in the month of July, the NAV of the Edelweiss China fund fell by about 15%. And it has been somewhat languishing. It would have recovered maybe 2 or 3% only from its lows. So I would suggest high-risk appetite investors can, you can avoid China funds. Only somebody with a very high-risk appetite can, look at, investing in China. I would consider investing better in a diversified US fund for diversification. Like a Franklin India feeder fund is there. So that invests in a diversified portfolio of overseas companies.
Just a follow up on that, Gaurav, if you could tell us, what were the returns of those funds? Did it make sense for anyone to invest in those funds over the last few years since their inception?
You're talking about the China or the US fund?
The China funds.
With China, like I said, if you're looking at the last 10-year track record, it's around, still the return is around 15 to 16% even after this fall. And the 5-year return is close to 20%. But if, like I'm saying, for a high risk appetite investor, if he's already exposed to domestic market and he has some maybe US portfolio as well, and he's looking to diversify into another country, he could consider a small exposure to the Chinese market.
Okay.
Otherwise, I would suggest it would be avoidable.
Okay, no more than a small exposure unless you are an extremely high risk taking investor, and it is avoidable as per Gaurav. With that, we move on. When John has written to us, he's shared this query with us on Twitter. With cryptocurrencies in focus, he wants to know if there is any Indian mutual fund that invests in cryptocurrencies. Well, Harsh, crypto, that's the buzzword, right?
Absolutely. And in fact, currently we would see that there are no such schemes that invest into cryptocurrencies directly. However, Invesco had attempted to launch one of the schemes which would invest into companies that have a potential to participate in the blockchain technology and cryptocurrency. So there are two elements to this. Everything in the blockchain is not cryptocurrency. But nevertheless, looking at the introduction of the new regulations which will come in this winter session of the parliament with respect to cryptocurrencies, I don't see anything coming out in the near future which invests directly into cryptocurrencies and even blockchain for that matter. So as I said, the Invesco fund of fund which was being introduced has also been called off. So I don't think there is anything at this juncture to, and even for investors, I would recommend wait for the regulations to come out where exactly you will know what is, not banned, what is legal to invest into, what is recognized by the government, and then take a plunge into whichever options that are available at this point in time.
Right. With that, we move on to the other query. Anil Kumar writes to us from New Delhi. He has been investing in the DSP Midcap Direct Fund for the last 5 years, and that fund is underperforming as compared to the other funds in the same category. He is contemplating to switch to Nippon India Small Cap Fund. Wants to know if this would be a good move. Gaurav, DSP back in the day, the Small Cap Fund, of course, was a star outperformer, and now the Midcap Fund has underperformed over the last 5 years. Do you think it's a good time to switch when your fund has underperformed for the last 5 years, or maybe get some outperformance and go to another fund?
Yeah, just to clarify his query, mid-cap fund basically invests in companies from the 101st company to the 250th company as per market capitalization. And similarly, the small cap usually goes greater than 250, maybe up to 500. So if he is a high risk investor and he believes that, he doesn't mind taking the risk that, small cap funds would have definitely a higher standard deviation and a higher risk than, mid-cap fund. So, it would be advisable if he's just looking at a pure mid-cap to, consider like a PGM India mid-cap opportunities, which has given a 5-year return of around 25% vis-a-vis the DSP, which is around 19%.
But
the Nippon small cap would have given a very good consistent return, but then it all depends on his, overall risk profile.
All right. So you would ask him to, if he's wanting to do it in mid caps, it would be PGIM, else go into the small cap fund, right?
Right.
Perfect. On that note, we'll take a break. Harsh, Gaurav, thank you for waiting by. Just take a short break, come back. We continue our conversation with both of them. Welcome back. You're watching us here on Mutual Fund Corner with Harshvardhan and Gaurav to take us through some of the mutual fund queries. Let's talk about another one coming in from Pune. Suhas Naik writes to us. He's a first-time mutual fund investor. Good start, Suhas, to start with mutual funds. He wants to start SIPs with a monthly investment of rupees 10,000. He would like to know what funds to put his money in for the long term. Well, just trying to look at some more, queries coming in the sense that some more details that he would have given. Doesn't seem like there are many, but the point is that he wants to invest for the long term, starting with a monthly SIP of 10,000 rupees. Harshvardhan, what is the best place to go?
Mangalam, there would be a couple of options, as you rightly said, would be dependent upon what are the other parameters. Like, it will depend upon the time horizon that he would have, what are his goals, if he could indicate his risk profile. Nevertheless, understanding that he's a first-time investor looking to invest for long term, I'm assuming that in the lack of the information given. So he could most certainly start with two products. One is, of course, an index fund. Now, index would enable him to invest into equities which are large cap in nature, easily to monitor and track. So, index funds would be one such option. And the other, he could start with a hybrid fund. Now, this could be just so that he gets, comfortable in the system of investing into equities. And as he kind of gets, conversant and comfortable, he can keep increasing his investment. So yes, first recommendation would be to go in for an index fund, a Sensex or a Nifty base, and the other would be on a hybrid fund. I could recommend names of the schemes as well, but I just thought if he could come back with little more information, it would be better for him, especially considering he's just starting off his journey.
Right. Gaurav, your thoughts? Would you have some names?
I would suggest maybe look at also like a Parik FlexiCap fund, which has a bit of overseas diversification of about 20-25%, and 65-70% is going into domestic equity. That fund was launched in 2013, and I've seen that even the market falls, that fund has fallen much lesser than market because of having a overseas component. So the standard deviation of that fund is also lower than compared to even the index as well. So, that is a good option he can, consider as well.
All right, let's move on to the other query. This one comes in from North in Lucknow. Jamal Ashraf writes to us. He holds about 50,000 approximately in debt funds. He wants to know if he should switch to a floater fund if the RBI raises rates. Well, sometime next year is what the projections are. Do you think that would be a prudent strategy, Harsh?
Mangalam, in fact, my view is that for retail investors, it's better to stick to a short duration fund for that matter. For a simple reason, interest rates will keep fluctuating continuously. I mean, they're not, sometimes the movement will be, large, sometimes it will be just minor, but they're going to keep moving all the time. Now, how far can a retail investor keep tracking those movements and switching between floater rate funds and coming back into, say, short duration, medium or long-term funds? So, my recommendation would be that to stick to short duration funds. They would be far more convenient for him to, continuously manage and invest. Every time you do this switch between two different types of schemes, there is going to be a tax implication as well. And keeping in mind the availability of true nature of floater rate fund bonds is also a concern. And the trickle down effect of the interest rate movement to actually be reflecting into the returns in your portfolio, there is going to be a time lag in that as well. So putting everything together, keeping in mind the convenience factor, the involvement of a retail investor to continuously actively manage the debt portfolio, I would recommend a short-term fund fits the bill well for at least this particular profile of the investor.
All right. With that, we move on to the last query for the day. Parth Shah writes to us from Vadodara. He's a 21-year-old with a stipend income. He has 3 SIPs in mutual funds. The breakup is as follows. 1,500 rupees is what he puts in a Nifty 50 index fund, 1,500 in active FlexiCap fund, and 500 in an SIP fund. He wants to know if he should change something in his portfolio. Well, for whatever it's worth, just 2 big thumbs up to Parth Shah. He's getting a stipend, and instead of spending it on things a lot of 21-year-olds would go ahead and spend it on, he's actually managed to, have 3 SIPs, and it's a fairly balanced SIP as well in terms of, the breakup. He's put some money in index funds. Harsh was talking about that earlier itself, and then he's also, added some money in a FlexiCap fund. And there is actually, one is a Nifty 50 index fund, and the other 500 rupees is an S&P index fund. Gaurav, what would you say? I mean, it's great intent, great execution. Hope he sticks by this discipline. Are there any tweaks he needs to do?
Yeah, I think Parth has really, nailed it as far as, his fund color selection is concerned. Only my opinion would be, instead of the S&P 500, index fund, which is, investing in 500 overseas stocks of the S&P 500, he can consider the Mirai Asset S&P 500 Top 50 ETF, which is basically like your Nifty ETF, but listed in the US. So it's, covering just the top 50 US companies rather than, covering the full 500 universe,
Okay, so you're saying instead of the S&P 500, you just go to the top 50 in S&P fund.
Yeah.
It's given by Mirai Asset, right? So that's great strategy, actually. I'm just looking at it. 1,500 rupees, you put it in Nifty index fund, then you have some money coming in flexi cap as well, and some overseas investments. To top it all, you're just 21, so you have a long runway to go. Parth Shah, I will watch out for you in the future. But as we were getting all your queries answered, we actually got one from Mangalore right away, and this one comes in from Ruben Almeida. He wants to know if an equal weight fund is better in a rising market or falling market. Harsh, I mean, what are your thoughts? It's an open question here.
Well, in fact, if you were to look at the data points for the last 21 years, we will see that, the equal weight index tends to protect the downside better than the market cap based index. So, answering specifically to his query whether, equal weight protects the downside better or the, upside, I would say yes, the data shows that the downside is protected better. But that does not mean that it does not perform well even in the upside when the markets are on the uptrend. In fact, if you see the data of, last 21 years, as I said, 12 out of those 21 years, the equal weight index has performed better than the market cap base. Now, there are a couple of other advantages if I could very quickly highlight. When you go for an equal weight index, you would have a lower, concentration in per company. So like market cap based index would have about 12 to 13% in Reliance Industries. The equal weight would have 2% allocation to that. So there would be a lower concentration for per company basis and even in the sector basis. So you not have that much concentration in any one particular sector because it's equally spread across, say, 50 companies for that matter. And even if you look at the ratios, you will see the price to earning and price to book ratios of the equal weight index is lesser than that of the market cap based index. If you look at the dividend yields, the equal weight has got a better dividend yield. So all in all put together, irrespective of whether it protects the downside better or is beneficial in the upside, I think an investor can immediately look at an equal weight index, even from an allocation point of view, without getting into the details. What does it do better than a market cap?
Are you mindful of any of the names that provide these services?
Yes, so Aditya Birla has one equal weight Nifty 50 equal weight index fund, and one could look at investing into that. That basically does nothing but divides the investments into all 50 constituents of the Nifty 50 equally, so that is about 2% allocation to each company.
All right, fair point. Thanks a lot, Gaurav, as well as Harshvardhan, for joining in, answering all our viewer queries today with regards to the Mutual Fund Corner. You remember to email us all your queries. We will answer them with all our experts. We wrap up on this, on this note with the news that the market's actually doing rather well. In the last half an hour of trade remains, or rather last 1 hour of trade remains. We leave it with the team of Closing Bell to take you through the last hour of trade.